In the year 2000, Enron reported $101 billion in revenue. Operating out of a towering glass headquarters in Houston, Texas, it was America's seventh largest corporation and celebrated by Wall Street as a paragon of corporate innovation. By the end of 2001, it was completely gone. The company filed for bankruptcy, vaporizing $74 billion in shareholder wealth and leaving thousands of employees with empty retirement accounts. Enron started in 1985 as a highly conventional business. Following a merger of two regional companies, it operated physical natural gas pipelines. It owned heavy assets and delivered a tangible product. That changed in the early 1990s. As the federal government deregulated energy markets, executives Kenneth Lay and Jeffrey Skilling saw an opening. They pivoted Enron away from physically transporting natural gas and instead began trading energy contracts like a financial commodity. Moving from a physical utility to a financialized trading hub meant Enron no longer had the steady, predictable income of pipeline fees. To keep their stock price climbing and attract continuous investment, the executive team had to project a narrative of relentless, exponential growth to Wall Street every single quarter. To maintain that illusion of hypergrowth, Enron adopted the merchant model of revenue reporting, and in 1992, they secured SEC approval to use a technique called mark-to-market accounting for their energy contracts. This diagram illustrates exactly how mark-to-market accounting distorted their books. When Enron signed a 10-year energy contract, they didn't record the revenue as it came in year by year. Instead, they estimated the total projected profit for the entire decade, and that massive sum was booked immediately on the current day's balance sheet. By keeping our focus on this same contract, the structural flaw becomes obvious. Enron was reporting staggering paper profits, but actual cash from these long-term deals hadn't arrived yet. When their highly optimistic future estimates failed to materialize into physical cash, it generated a massive internal deficit. Because mark-to-market accounting forced them to record projected profits up front, executives could not adjust for later losses without admitting their previous numbers were wrong. To avoid triggering a stock collapse, they began constructing elaborate financial mechanisms to hide their lack of cash and mounting debt from the public. The executive tasked with hiding this financial reality was Chief Financial Officer Andrew Fastow. Fastow's solution relied on creating thousands of off-balance sheet shell companies known as Special Purpose Entities, or SPEs. He gave them obscure names like Chuco and the Raptors, setting them up as supposedly independent partnerships. Looking at this corporate structure tree, you can see the engine of the fraud. When Enron had a failing investment or took on massive debt, it simply transferred those liabilities to the SPEs. By moving the toxic assets into these black box entities, the debt was shoved off its own books, instantly restoring Enron's main public ledger to a healthy, profitable green. Still looking at the flow of capital, we see how Enron solved its cash shortage. Major financial institutions like JP Morgan and Citigroup used a mechanism called a prepay. They disguised billions of dollars in loans to Enron by legally categorizing the cash injections as commodity trades, allowing Enron to avoid reporting the incoming money as debt. By combining these off-balance sheet shell companies with disguised loans, Enron built a machine that manufactured billions in fake operating cash flow, legally blinding outside investors to the toxic reality of the company's finances. This machine was sustained by a brutal internal evaluation system known as rank and yank. Every year, Enron systematically fired the lowest-performing 15 employees were heavily incentivized through massive bonuses to secure short-term deals and book immediate profits, regardless of long-term viability. Anyone who questioned the ethics of the accounting practices was quickly pushed out. Even with internal dissent silenced, Enron's public financial statements still had to be legally verified by an external independent auditor. That role belonged to Arthur Andersen, one of the most respected accounting firms in the world. But Arthur Andersen had a severe conflict of interest. While they were paid to audit Enron's books, they were simultaneously earning millions of dollars in highly lucrative consulting fees from Enron. To protect that consulting revenue, Andersen auditors actively ignored glaring accounting violations and signed off on the fraudulent reports. Enron's survival relied entirely on this dual failure. It required a toxic corporate governance structure to generate the fraud internally, and a compromised independent auditor to validate it externally. The facade finally began to crack in early 2001. A piece published in Fortune magazine asked a basic but persistent question: how exactly was Enron making its money? The company's refusal to provide clear answers generated the first wave of public skepticism. Internally, the unraveling of this massive fraud started with Vice President Sharon Watkins. While working in corporate development, Watkins traced the flow of Enron's assets and discovered the massive, unsustainable debt hidden within the special purpose entities. In August 2001, Watkins drafted a memo to CEO Ken Lay, warning him the company was going to implode in a wave of accounting scandals. Lay ignored her recommendations for an independent investigation, and that same month, Jeffrey Skilling abruptly resigned. The tipping point arrived on October 16, 2001. Unable to hide the bleeding any longer, Enron disclosed a massive $638 million quarterly loss and announced a $1.2 billion reduction in shareholder equity, tying the losses directly to the previously hidden partnerships. The announcement triggered a market panic. Enron's stock price went into freefall, their credit rating was slashed, and investment capital evaporated. By December 2, 2001, the company filed for Chapter 11 bankruptcy. The company was incinerated overnight. The extreme gap between the public illusion of endless profitability and the private reality of crushing debt meant that once the market realized the truth, the company had zero actual foundation to fall back on. The collateral damage was severe. Over 5,000 Enron employees lost their jobs and their pensions. Arthur Andersen was criminally convicted for shredding audit documents during the subsequent federal investigation, forcing the firm to dissolve and costing 85,000 jobs worldwide. Elon's collapse shattered public and investor confidence in the broader stock market. If the seventh largest company in America could manufacture its entire balance sheet out of thin air, investors demanded to know who else was lying, forcing immediate federal intervention. Congress responded swiftly by passing the Sarbanes-Oxley Act in 2002, marking the most significant overhaul of corporate accounting since the Great Depression. The Sarbanes-Oxley Act introduced strict new disclosure requirements for all off-balance sheet transactions. It also created a new federal board to independently oversee the auditing industry, and it made corporate executives personally, criminally liable for the accuracy of their company's financial reports. Enron served as a systemic wake-up call that permanently rewired American corporate law. It proved that no matter how sophisticated the financial engineering appears, complex corporate structures that operate without radical transparency are always just a house of cards waiting to fall.